All right, good evening, everyone. This is Mr. Scamitzi. Just in the interest of time, I am going to go ahead and get started. I do like to start out the classes whenever I can, just with I think I like to start best with just kind of current topics. And so I'm open to just kind of having more of a discussion. And you're welcome to use the chat. You're welcome to unmute your own line and ask a question if you want to, just about current events. I feel that when I can tie in things that are, I figured that was going to be part of it. Tying things that are actually going on real time, the things that you learn throughout the course of the semester will help. Okay, so it looks like, diamond hands are coming in. Okay, I think I might be in the paper hands group. I don't know. All right, so I was kind of expecting some questions about what's going on with Wall Street bets on Reddit, and I can't remember the reference of HODL. I can't remember the genesis of that, but all right. So let's talk about what's going on with the Reddit forum and how it's impacting stocks like GameStop, Nokia, Best Buy, BlackBerry, things like that. So let me share my screen. Make sure I don't have anything sensitive open. Pretty sure I don't. I try to do that. All right. So feel free to stop me and ask questions. I don't, interrupt me. It doesn't bother me when you do that. Some professors might, but I don't. It doesn't bother me at all. So let's see. Let's get participants. Where's the chat? All right, so I'm not going to pull up the Wall Street Bets site because it's a little bit crass, and trying to keep this in a respectable class setting. I'm not going to introduce that. You can look at it all you want on your own. So first of all, what's been going on with specifically GameStop? So GME. Let me pull up a Yahoo Finance. Does anyone want to take, rather than having me explain, how I perceive things happening, does anyone want to take their own chance at explaining what you think's been going on with GameStop over the last 2 weeks? I can have a crack at it. Go for it.
All right. I've been following this for about a week, and it's been really interesting. So this basically started off when GameStop got their new CEO, and there was a Wall Street Bets character whose name I can't say in the interest of keeping the class clean.
That's fine.
But he basically bought in at $3 a share about a year ago. Now, GameStop has been historically really, really shorted. It's something that has been very clean investment to short, but it's been getting to the point where they have 140% of their shares have been shorted, more than available shares to the public. So in an attempt to kind of counteract this and take the stock to the moon, the Wall Street Bets community decided to do what's called a short squeeze. So when the stock gets shorted, someone borrows the stock from someone and promises to give it back at a later date. They sell the stock immediately, betting that the value of the stock will go down. And by the specified period of time, they have to return however many shares they borrowed. So by skyrocketing the value of the GameStop stock, Wall Street Bets community has effectively cost everyone who was shorting GameStop to lose a lot of money. That leads us to what happened with Robinhood today. Because of the extreme price volatility, they decided to suspend only purchase orders instead of all orders. And that's kind of the short version of it. There's a lot more going on, but
Also, Robinhood.
Go ahead.
Also, Robinhood forced people to sell without consent shares in GameStop. I did see that earlier, like around Twitter going around.
Yeah. Anyone else want to share your own perspective before I give you mine, which is going to probably be, not really the anger you see on Wall Street bets.
Are people mad? I thought only traders. I thought only hedge fund people got mad about this.
The retail investors got very mad when Robinhood blocked purchase of trades.
Yeah. Well, of course, that's the thing to get mad about. But it's like we'll just do it again. All
right. So in the interest of forging ahead, I'm going to go ahead and give you my read on how this works. There was a question in the chat of whether or not attendance is required. Attendance is not required. I'm pretty sure I can download the attendance records from Zoom, which I will do. And I'll just use that for if there's an opportunity for me to provide some extra credit boost, I will. All right, so short selling, that's essentially, I'm sorry, who explained the short selling part? Who's the first person?
That was me, Professor Jason Hall.
Jason Hall, thank you, Jason. So that's exactly right. Short selling is where an institutional investor usually, but you can do this in margin accounts as well as a retail investor, but they will go to a broker dealer and borrow shares from margin accounts. And that's how Robinhood funds itself. So anyone who has, and just to be clear, I want to be sensitive to the fact that there may be some of you who have been dealing in this in your own personal investments. And, this is very risky stuff that's going on. So they call up broker dealers, institutional investors call up broker dealers and borrow shares. It's called a stock loan. And they go to all their margin accounts and they say, okay, well, how much do you want? Here's how much collateral we require for you to borrow these shares, sell them short, and here's how much interest we will charge you, because it is a loan. And so they will be charged interest. Robinhood does that with all the shares that the retail investors own in their accounts. And once it's shorted out of your account still reflects the value, but you are no longer able to participate in things like voting rights, if that's important to you. If it's not, then don't worry about it. You still get the participation of dividend payments that will get deposited in your account at the cost of the short seller. And I'm looking at short interest for GameStop, and at the end of the year, the ratio was, or actually in the middle of January, the ratio was 2.1. And at times in the past was high as 25. And I take that to be 25 times the float. And so that's exactly what happened with Wall Street Bets. The community essentially galvanized to do a short squeeze, and they just started buying up shares and holding them. And so causing that buying pressure bid up the price, which means that those investors who had sold short were incurring significant losses. And these are investors who have very long track records, and that's not to say that they're necessarily savory people. I want to be sensitive also of not throwing names around and making fun of people or calling people names, but there are some people who do some underhanded things in financial markets. You still get dividends when you're short. Yes, the short seller has to pay them. If there's a dividend while it's sold short, the short seller has to actually also pay the dividends to the account. So that short squeeze bid up the prices. The short sellers had to go and repurchase the prices because the broker dealers were essentially calling them and saying, you have to either post more collateral or return the shares because you're sitting on a pretty big loss. And big hedge funds have lost a lot of money due to this. And the price just kept on going up and up and up. And as the investors were buying more and more, the retail investors were buying more and more, that actually was reducing the float, reducing the actual available shares out there. If you're just buying and holding and not selling, that provides huge purchase pressure and effectively limits the effective float in the marketplace. And that caused prices to go higher and higher and higher. And this is completely unmoored from the fundamental value of the company, in my opinion. And you can have your own opinion or belief, but in my opinion, this is absolutely unmoored from what the actual value of the company is. Today, Robinhood and essentially almost every big retail brokerage said essentially we can't fill any buy orders. And part of it has to do with the delivery aspect. When you purchase a share, the party that sold it has until the close of trading on the second trading day following. So if you purchased it yesterday, Wednesday, after trading on Friday, the actual physical shares have to be transferred in custody to your broker. If it's not, then that's a failure to deliver. Brokers will step in and essentially say, okay, I have a client that bought, so I'm going to sell, short sell, and I'm going to go out to the market and actually buy the shares to deliver the account. Robinhood, Ameritrade, Fidelity, the purchase orders were coming in so fast and driving the prices to such high volatility, they hadn't come in to stop that, to slow that, and so they just were doing things as routine business. Okay, well, we'll sell short, go to the marketplace and buy to deliver, even though we haven't matched a sale, we're just doing it on behalf of our client. We have to close out our short position. And so the broker dealers are in fact selling short to meet client demands. So when someone in the class, if you purchased through Robinhood, they probably didn't have a matched sell. They probably sold short to you and then went out to try and buy the shares to cover. But then they started incurring losses. And if you're questioning whether or not that's the case, this just came out. Robinhood is rumored to have to draw on bank lines because they are having a difficult time actually covering the short sales they made to their clients using open market transactions. So because the bid-ask spreads have gone so wide and the volatility has gone so crazy, Robinhood is losing money on their market-making activity. So this activity is actually risking breaking Robinhood's business model. So they halted the purchases through their app because they could not actually cover it and remain a viable business, is the way that I read this. It became a huge risk to their viability as an ongoing business. On top of that, someone mentioned in the chat and someone mentioned it verbally, the forcing sales or forcing closing, closing of positions. For investors who were leveraged long or had written calls short, so that means they didn't, naked calls, they didn't actually own the underlying and they wrote the call. Robinhood had actually said that is too much margin exposure for them. So they actively went through in any kind of leveraged or naked position when it's an option contract, they closed it out. because they couldn't bear the risk. What's the difference between hedge funds doing it versus momentum plays and versus, retail investors? It's not. It's just that the wave became so big that these broker dealers have no way for handling it. So let's see. I see some comments in here that is this manipulation? And you can use someone who, if you're comfortable sharing your opinion, do you think Robinhood is being manipulative in their actions?
Can I ask a quick question first?
Sure. Go ahead.
I've heard this kind of widely circulated, but I don't know if it's true. But that Robinhood is basically owned by Citadel.
I don't know, because they're a private company. They might, they very well, so they could have a private equity injection from Citadel. I don't know.
Because Citadel manages several hedge funds, which would have had substantial gains over the course of people being locked out for trading, because it would have allowed them to recoup a lot of the losses from the short sales.
Yeah.
And if that's the case, then it is 100% manipulation.
So usually for startups like this, the seed money, they typically had some form of way for the founders to prevent the private equity investors from having too much control over the company. Think about Snap and things like that. But that seems very, I don't want to speculate on whether or not Citadel owns them or has a private equity stake in them.
Do you see anything happening to quell this kind of thing in the future? Because how it happened makes it kind of sound like, Wall Street bets could do this about 5, 6, 7 more times before anyone figured out how to stop them. Not that I mind.
Yeah.
I mean,
well, it sounds like you went long a couple days ago. This actually scares me.
Yeah.
As someone who's been following financial markets for, I guess I'll reveal my age a little bit. 25 years.
Oh.
And so this actually scares me because of the risk that it could actually break, do a lot of harm. And I understand the misgivings of, they all these hedge funds that do it all the time. Yeah, but most hedge funds actually go out of business, and especially the ones that are short selling activists. Like, it's a very select few that can actually survive for the long term that specialize in short selling.
Okay.
So the ones that, if you want to go listen to someone who's actually really very good at short selling, and even he does not have a perfect track record. It's his name's Jim Chanos. Here he is. He's probably one of the best short sellers of all time. Extremely humble guy. He says part of it is just he's been lucky at times. There have been times where he thought he was going to completely go bust, and he's been doing this since like the early 80s. He's a specialist in short selling. What's the name of this fund? I can't see because my window's blurred. Kinnikos. But it's not an easy thing to do. And the type of activity that's been going on, we call it momentum trading. Investment banks used to do that back in the early 2000s, and then they got in a lot of trouble for it, rightfully so. And so now we have this wave of, it looks more like people who are used to gaming, and they're taking that kind of mindset and doing it in financial markets, and it's creating something that to me it scares me. Very, just very simply scares me. So when is this fever dream going to break? I don't know. According to Wall Street Bets, they're expecting, tomorrow is going to be the big event. And someone already put it in the chat, to the moon.
Big event. Did they already choose another? Oh, AMC. I already knew that. Okay.
Yep. So
well, they're just expecting
what's
that the
supposed to
short
happen
coverage,
tomorrow?
I bought it.
The forced short covering is they're expecting that forced short covering is really going to be pushed tomorrow, where the investment banks are going to essentially call the short positions to cover. And that will essentially mean billions of dollars are going to go to purchase shares of GME to close these short positions. And that buying pressure, people on Wall Street Bets are kind of, I don't know if it's just bluster or if someone's actually done the thinking. They think it's going to go to $1,000. I don't know. AMC is essentially on the threshold of filing bankruptcy. They've got essentially a bridge loan to get them through another few months, but the value of AMC as a company is practically nothing right now. And so these are companies that have a lot of short interest, and someone figured out, we can go and find some filings to figure out which companies have a lot of short interest and force a short squeeze and drive up the price this is ridiculous. Absolutely ridiculous. It has nothing to do with the company. It has all to do with market mechanics. And so who's manipulating whom here is a question I would ask. I think everyone's doing a little bit of manipulation, but who's the big manipulator here?
I would say the hedge funds.
I would say it's kind of weird that it seems like half of a good bit of the value in stocks anyway is just based on confidence. And it doesn't even matter that that's based on earnings reports. It can be, lots of times it is, but it doesn't matter if it is. And in this case, it doesn't. What matters is that I can play with the mechanics to make it look like everyone's really confident in it.
Mm-hmm.
And that's,
one of the things that they were reporting on was that there was actually a spike in short sale interest today as well, because what was happening is these hedge funds are all basically selling the shorts back and forth to each other in order to make it look like there's a sell-off.
It's pretty funny.
I don't know how true that is. I would say that probably some hedge funds were closing their shorts, driving the price up, and then other hedge funds came in and said, "Oh my gosh, I can't believe GameStop is at 350. I'm going to go and borrow shares and short it if they can." But I don't know that it was a coordinated thing where they're passing it off to each other. But this is all these are things that we don't know. We're not going to have access to that data or information. It would come out if
that still presents a big problem, though, if they're still being able to do that, but retail investors can't actually buy market shares on them, though.
I don't. You have to read the legal disclosures. Have you read all the legal disclosures from Robinhood?
New York's website crashed with
So
that filed a
lawsuit
in New York and it crashed.
Yeah. So that goes into how Robinhood makes its money. By giving you access to doing all this with, I don't know what the minimum deposit is. Is it $10 with Robinhood? I have no idea. But for very low initial costs, and you can buy fractions of shares, you are also giving them the right to do what they are doing. That's part of the agreement. And so this kind of market activity is extremely risky. And this is a case of a crowdsourced, in my opinion, the way that I read this is that the crowdsourced activity is actually manipulating the market and doing a giant momentum trade. I'm not saying that it's good for anyone to do a momentum trade. That's reckless. But the amount of momentum trading that's going on here, to me, is scary. That's my take on it. Okay. Anyone have any last comments before I move on? Because we have been talking about this for longer than I probably intended to. Okay. All right. Any questions about practice problems? I realized last night that I never posted the practice problems from the textbook. I think someone asked me to do that in the chat. I'm sorry that I forgot. It just slipped my mind. If you want me to, I can post them to Canvas if you don't have the textbook yet. But again, I'm only going to do that for the first set of practice problems. But any questions about the practice problems or the quiz? Okay. All right, so next on the syllabus, and hopefully we can keep to the schedule, we're going to do bond markets, and we're going to start talking about bond prices, yields and characteristics. All right,